The S&P 500 is a flagship index of some of the world's greatest companies headquartered in the US but that do business all over the world. Some of the best advice out there on the market from some of the world's most seasoned professionals just says to buy and hold funds like the S&P 500, invest monthly, put in lump sums, and over a long period of time, you'll do pretty well. In fact, it's not just advice, it's a proven strategy that's worked well over a long period of time in the market, and even seasoned stock pickers like Warren Buffett himself advocates the use of long-term index fund investing as some of the best ways to make the most of your money. But wait, is it really just that simple, that all you need to do is invest in the S&P 500 and everything else will be rosy? Well, there's a couple of little things which we need to check out because it really isn't just that straightforward. I'm going to let you in on a couple of different secrets and then challenge the idea that all you need is the S&P 500, because all is not what it seems. And this isn't any complicated concept or anything like that. There's no weird thing you need to invest in here. It's quite a simple concept, so by the end of the video, you should be in a better position to understand how you might want to allocate your portfolio and think about it, especially for the long run. The secret sauce I'm talking about today is all to do with the key word that is diversification, which, as we know as long-term investors, is an extremely important part of investing to make sure that we reduce risk and make sure that we get our fair share of market returns. However, diversification can be quite misunderstood by lots of investors, and lots of people throw the word diversification around without really understanding what it means, because it doesn't really mean that the more stocks you have in your portfolio, the better diversified you have. It's a little bit more complex than just that. There have been countless studies done on the academic side looking at how many shares you actually need to hold in your portfolio to be able to reduce your risk against the market, and there is a balancing point to be had about how many you actually need. Harry Markowitz is probably one of the best known academics in this field, and he founded what we now call modern portfolio theory. And this really just breaks down in simple terms to figuring out, as investors, where do we put our money in the market to get the most returns and to reduce our risk at the same time. The theory can be broken down to two very simple parts. Firstly, that everyone wants to maximize their return for their level of risk. Seems fair to me. And secondly, we can reduce our risk by diversifying our portfolio through individual, unrelated securities. So what this means in practice is that we actually need to hold different stocks and shares, firstly in different industries and sectors, but also making sure that we hold other assets in different asset classes too, to actually have a properly well-balanced and diversified portfolio. For example, if we only had Facebook in our portfolio, well, they're actually called Meta now, and I just did a video talking about them quite interestedly, and the whole metaverse. This is an interesting point, definitely something worth checking out after this video. But let's say we want to diversify that portfolio, which was 100% Facebook. I think we would be a little bit crazy if we then said, right, I'm going to put 50% of the rest of my portfolio in either Twitter or maybe even Snap. This is because, quite simply, Facebook would be in the exact same sector as Twitter or Snap, being a social media giant. Therefore, if Facebook stock went down, it would be highly likely that both Twitter and Snap would follow the exact same suit, because they're faced with exactly the same or very similar industry challenges. The exact same theory applies if we were to invest in two different banking stocks. Just because we divided our money between two different companies, it wouldn't mean we were eliminating the risks that would happen in that exact sector. And in fact, we'd be much better off diversifying in a completely different sector, and this would be a much more preferred route. So for example, we might want to balance a bank stock with a tech stock, for example. Making a lot of sense so far? But wait, hold your horses, hold your horses. I know what you're saying. Hang on. The S&P 500 is already well diversified. There's 500 different companies in there. I'm not worried about diversification. I've got 500 companies to talk about. Well, it's not that simple. Now, that statement is mostly correct. The S&P 500 is well diversified. It does have multiple different sectors, and these companies also trade globally too. So they generate a lot of their wealth from outside of the US too. But however, they are missing just a few different things which during certain periods of time in history have cost them potentially pretty dearly. For example, just a couple of weeks ago, I was talking about the impact of small cap stocks and smaller companies in the market and what they've historically returned throughout the past. Small caps have actually delivered, on average, over a long period of time, more returns than their larger cap stock brothers and sisters, believe it or not, and that both applies over in the US and in the UK too. While they are a lot more volatile, they've actually returned a few more percentage points. So while small cap stocks might not let you sleep very well at night, if you would have completely missed out on them if you were purely invested in the S&P 500. So surely we're missing a big part of the market here. The S&P 500 would also miss some other areas of interest such as emerging markets, all the commodity markets? What about gold, silver, platinum, etc., and other precious metals? And let's not forget, in more modern times, of course, what about the cryptocurrency market too? We're going to miss out on a huge new different asset class if we only focus on the S&P 500. Here's a good example for you. Have a look at this. If we look at the market between the year 2000 and the year 2009, and we looked at an all US market index fund, this is VTSMX. Now, this is not one that you can get in the UK, but just bear with me here. We actually end up with less money than we started with. Have a look at this. Imagine that for nearly 10 years worth of investing, that is not nice at all. However, in the exact same scenario across the exact same time frame from 2000 to 2009, if we diversified our portfolio just a little bit more, we would end up with some massive returns. This portfolio mix would be something like 33% in fixed income, 27% in stocks, 14% in developed foreign markets, 14% then in the emerging markets, and 12% in REITs, which is basically real estate investing. This would have returned nearly double our initial investment, whereas the fund covering the US stock market in totality would have actually lost us money, as we've just seen. For a second example, let's look at something a bit more in modern times. Let's compare, for example, the S&P 500 against the total stock market. So again, we're going to take a couple of American ticker symbols here, but don't worry too much about that. Focus more on the message here. If we compare SPY against VTI, VTI actually beats the S&P 500, even though it holds mostly the same stocks. And of course, what's the difference here? Well, VTI, of course, holds everything in the S&P 500, but then of course it's holding a couple more thousand different stocks in those smaller sectors. And those smaller companies, although they'll be a lot more volatile, can tend to grow a lot quicker. As we've experienced before, we all know how easy it is potentially to turn £100 into £1,000, but trying to turn £1 billion into £2 billion is certainly a lot harder, even though the big tech companies sometimes make it look very easy. So what's the conclusion here then? Should you actually change the way you invest? Well, as usual, the answer comes down to you. It's all about risk and reward and what your current financial personal situation is and what your goals are and how long you've got to invest. Younger people like myself might want to have more risky positions. For example, we might want to have less in low-cost index funds and have a few different stock picks, and also then dip our toe in the water with the likes of cryptocurrency and maybe completely avoid bonds for the time being. Whereas on the other hand, of course, if you're looking at retirement or you're looking toward the later stages of your investment, then sure, you're going to look a lot more at those fixed income products, dividend paying stocks, for example, or maybe even a more heavy allocation to the likes of bonds, and completely forgetting about the whole cryptocurrency revolution. There's no right answer here, but the important thing is knowing what diversification and its effects can be on your portfolio. So rather than just having maybe a single stock which just looks at the S&P 500, for example, just consider some of the other factors involved and how much trust you might want to put in one single sector of the economy. It's good practice, as you'll know, and I did a video on this recently talking about inflation, that we don't know where the next set of growth is going to come from. And in fact, nobody knows where the next growth is going to come from, whether this be in emerging markets, different kind of commodities, the US, the UK, Europe, for example. And the best thing really we can do as investors is, rather than trying to guess, is to make sure that we own as many of the different asset classes as we can. As we know, in current times, we're in a dangerous game right now of super low interest rates and heavy amounts of cash printing, which is having a major effect on different asset prices, as we've seen over the last couple of years in the amount of increases we have in different kinds of assets, namely cryptocurrency, the stock market, and real estate, for example. These have all gone for a bit of a boom, and the US dollar, as we know, has printed 20 to 30% of all of its supply over the last couple of years completely. Now, of course, this might change in the future and interest rates might rise and stagflation might take hold, or who knows. But again, we don't know what will happen in the future, so it's best trying to make sure that we've got our allocations in different kinds of assets. Certainly one of the last things I'd want to do right now is have loads of cash on the sidelines because I want to wait for some sort of crash. How many times have we said this? In fact, if you listen to people like Robert Kiyosaki, as much as you might love his book and you might like his messaging, he's been predicting a market crash more often than you go and do your food shop. So I think I'd rather trust the fact that no one can predict the future and just make sure you've got as many bases covered as you can. So find out what works for you, make sure it matches up to your own goals. For me personally, as I mentioned many times before, the core of my portfolio will definitely stick with low-cost index funds because I know that's a proven strategy for my investing, but I do hold lots of individual stocks. I do hold a big chunk of cryptocurrency. I don't hold any gold. I don't hold any bonds. I look at crypto, especially Bitcoin and Ethereum, as a similar way that people have treated with bonds before, but the main part of my portfolio will always be in low-cost index funds. But of course, I've got my individual bets. I've got time on my side to be able to make those slightly more speculative risks. But overall, in all likelihood, low-cost index fund will probably win. But hey, It's a bit of fun. Anyway, I really hope you've enjoyed the video. Drop me a big like if you have. Subscribe for many, many more. Thank you so much for watching. I'll see you guys in the next one. And as always, happy investing.